If you're retired or planning to retire soon, you probably already know this truth. You can't afford to take big financial risks, but you also can't afford not to grow your money. And that's a tightrope every retiree walks. Because on one side, you have market volatility wild swings that can wipe out years of savings in months. And on the other side, you have inflation, slowly eating away at your purchasing power. So what's the solution? Low-risk investments. Not no risk. Not get rich quick. But stable, predictable places to put your money so it grows safely. In today's episode of Golden Years Finance, we're covering the best low-risk investments for retirees in 2025, the options that protect your principal, generate reliable income, and help you sleep peacefully at night. By the end, you'll know exactly where to put your money if your goal is safety, steady returns, and long-term security. Let's dive in. 1. Why low risk matters more in retirement. Once you retire, everything changes. During your working years, when the market dipped, you could wait it out. You had income coming in. You had time to recover. But now, a big market loss can take years off your retirement lifestyle. That's why financial planners call this stage your preservation years. Your job now is simple. Protect what you've built. Grow it responsibly. Avoid unnecessary risks. But here's a twist many retirees don't realize. Playing it too safe is also a risk. If you put everything in cash or a low-interest savings account, inflation will eat it up. So the key is balance, and that's exactly where the best low-risk investments come in. 2. The top low-risk investments for retirees in 2025. Let's break down the smartest, safest, and most reliable options for retirees today. 1. High-yield savings accounts, HYSA. Best for emergency funds plus liquidity. These aren't investment growth engines, but they are essential. In 2025, many top banks are offering 4 to 5% interest, which is significantly higher than traditional savings accounts. They are FDIC insured, meaning your money is protected up to $250,000. Use HYSAs for emergency funds, short-term spending, your safe buffer money. They won't make you rich, but they'll keep you secure. 2. Certificates of deposit, CDS. Best for guaranteed returns plus short-term stability. CDS are perfect for retirees who want predictable, guaranteed returns. In 2025, you'll find 5% plus rates on 6-month to 2-year CDS. The smartest strategy? Build a CD ladder. Buy CDS with different maturity dates: 6 months, 1 year, 18 months, 2 years, so you always have something coming due. It creates steady cash flow without taking risks. 3. Treasury bills, notes, and bonds. Best for safety backed by the U.S. government. Treasuries are the gold standard of low-risk investing. You can choose T-bills, short-term, T-notes, medium-term, T-bonds, long-term. In 2025, yields remain strong, especially on short-term treasuries. The best part? No state or local taxes. Highly liquid. A safe haven during market turbulence. 4. Treasury inflation-protected securities. Tips? Best for protecting purchasing power. If inflation worries you, tips are essential. The government adjusts your principal based on inflation. So even if prices rise, your investment value keeps up. They're ideal for retirees who want zero surprises. 5. I-bonds. Best for inflation plus tax advantages. I-bonds were extremely popular between 2022 and 2024, and even now they're a solid option for retirees. Benefits: interest adjusts with inflation, taxes deferred until you cash out, government-backed. They are not perfect. You can only buy up to $10,000 per year, but they help build a strong, low-risk foundation. 6. Fixed annuities, not variable annuities. Best for guaranteed lifetime income. Fixed annuities can act like your own personal pension, guaranteeing monthly income for life. What retirees love. You can't outlive the payments. Rates in 2025 are strong. No market exposure. But you must avoid variable annuities. Too many fees. Too much risk. Too much complexity. Stick to simple fixed annuities or fixed index annuities with caps. 7. Short-term corporate bond funds. Best for higher yields with low volatility. Short-term corporate bonds offer better returns than Treasury bonds, with manageable risk especially if you choose. Investment-grade companies. Short durations, 2 to 5 years. Low-fee bond funds or ETFs. The key here is quality. You're not chasing high-risk junk bonds, just stable, steady fixed-income assets. 8. Money market funds. Best for parking cash safely. Money market funds are extremely low risk and often pay higher yields than savings accounts. They invest in short-term, high-grade securities. They're ideal for storing cash, making withdrawals, creating income without locking money up. Just remember, they are regulated, not FDIC insured, but they are still considered very safe. 9. Dividend-paying blue-chip stocks. Conservative allocation. Best for low-risk growth plus consistent income. Not all stocks are risky. The right ones, stable, profitable companies with a 25-year history of raising dividends can be incredibly dependable. Examples include Procter & Gamble, Johnson & Johnson, Coca-Cola, PepsiCo, McDonald's. These are known as dividend aristocrats. While stocks always carry some risk, blue-chip dividend stocks are a balanced way to get steady income, protection against inflation, long-term stability. You don't need a lot, even 10 to 20% of your portfolio can help your money keep growing. 10. Stable value funds, available in some 401(k)s. Best for safe returns inside retirement plans. If you still have a 401(k), check if you have access to a stable value fund. They are extremely low risk and often pay 3 to 5% with minimal volatility. They are a hidden gem for retirees but often overlooked. 3. A simple, low-risk portfolio for 2025. Here's a model for inspiration, not financial advice, just a blueprint. 30% HYSAs and CDS. 25% Treasuries and TIPS. 20% fixed annuities. 15% dividend stocks. 10% money market funds. This keeps you safe, liquid, growing, protected from inflation, set up for long-term stability. 4. A real life story. The couple who played it too safe. Let me share a true story. Details change. John and Linda retired in 2010 with $600,000 in savings. But after the 2008 crash, they were terrified of the stock market. So they moved everything into a savings account earning less than 1%. At first, it felt good, safe, comfortable. But by 2020, they realized their biggest mistake. Inflation quietly drained their wealth. Groceries doubled. Gas doubled. Healthcare skyrocketed. Their money didn't grow, it shrank. They weren't irresponsible. They were scared. But fear cost them hundreds of thousands of dollars in lost growth. That's why finding the right low-risk, not zero-growth investments is crucial. 5. The biggest mistake retirees make. Here it is. Putting everything in cash. Cash feels safe, but long-term, it's dangerous. A balanced, low-risk investment strategy can protect your future far better than stuffing everything into a savings account. 6. Final advice. If you're retired or retiring soon, choose safety, not stagnation. Pick assets that grow gently, not aggressively. Avoid complex, high-fee products. Make income stability your priority. Keep inflation in mind always. You've worked decades to build your nest egg, now it's time to protect it wisely. Conclusion. Low-risk investing doesn't mean small thinking, it means smart planning. Retirement is not just about playing defense. It's about positioning your money so it keeps working for you safely, consistently, and reliably. So let me ask you, which of these low-risk investments do you already use, and which one are you planning to add next? Drop your thoughts in the comments. Your experience may help another retiree today. And if you found value in this video, hit like, subscribe, and turn on notifications for more practical retirement insights from Golden Years Finance. Because your retirement should be safe, steady, and truly golden.